Build your dreams, live rich, and leave rich.
Hello and welcome. My name is Krish. Today, we're going to talk about a strategy that is, quite honestly, the foundation of all true wealth. It's not a secret trick. It's not a get-rich-quick scheme. It is a simple, powerful, and timeless principle that can genuinely change your family's financial future for the better.
But first, let's just agree on what we mean by living rich. I'm not talking about flashy cars or lavish parties. I'm talking about that incredible feeling of peace you get when you can put your head on the pillow at night knowing that your family is safe and secure no matter what happens in the stock market tomorrow. That feeling, that is real wealth.
And of course, a quick but very important reminder. Everything we talk about here is for your education, to help you understand these concepts better. Your own financial situation is unique, so please, before you make any investment decisions, make sure you talk to a CB-registered financial advisor. They're the experts who can help build a plan that's just right for you.
All right, let's dive in. The single biggest and most dangerous trap that I see people fall into is this idea of the one magic investment. You know the story, right? That there's one perfect stock or one perfect plot of land, and if you just find it and pour all your life savings into it, you'll be set for life. It's a very tempting story, but believe me, it's an incredibly dangerous one.
And doesn't this sound familiar? Maybe you've heard it from your parents or your grandparents. Beta zameen mein invest karo. Land is never a loss-making deal. For generations here in India, this has been passed down like gospel truth. And it makes sense. It feels safe. You can touch it. You can see it. It's a powerful symbol of security in our culture.
But we have to stop and ask ourselves, in today's complex world, is that really the best advice? Is putting everything you have into one single asset really a risk-free path to wealth? Or could it be a comforting myth that's actually hiding some very serious dangers? Let's really look at this. So here's the reality of putting all your eggs in one basket, whether it's land or anything else. First, it's illiquid. That's a fancy word, but it means something very simple. If you have a medical emergency tonight and need 2 lakh rupees, you can't just slice off a corner of your plot to pay the hospital bill. Selling property takes months, sometimes even years. Second, the costs are huge. Think about it. Stamp duty, registration fees, ongoing maintenance, property taxes, it all adds up. But the biggest risk of all is the lack of diversification. If the property market in your city goes completely flat for 10 years, well, so does your entire net worth. And this leads to a terrible trap I see all too often, being asset rich but cash poor. You might own a 1 crore plot and be a crorepati on paper, but you're struggling to find the liquid cash you need for life's actual expenses. Okay, so if that's the problem, what's the solution? Well, the good news is there is a time-tested strategy, a formula used by the wealthiest families around the world to protect themselves. So give me the next few minutes and I promise to walk you through the ultimate sleep peacefully at night formula. You'll learn exactly how to build a financial fortress for your family that can withstand any storm the market decides to throw at it. And the secret to building this fortress is an idea that every single person in India will understand immediately. I want you to think about preparing a perfectly balanced Indian thali. This powerful concept is called asset allocation. Just think about it for a second. You can't make a healthy meal out of just a bowl of spicy pickle, can you? It's exciting, it's got a kick, but you'd burn your stomach. That's exactly what it's like to put 100% of your money into stocks. It's high growth, but way too risky on its own. On the other hand, you can't just live on plain rice and dal. Sure, it's safe, it's filling, but there's no real flavor, no powerful nutrients. That's like keeping all your money in fixed deposits. A perfect, healthy, and satisfying thali needs a carefully calculated mix. The spicy pickle of equity for high growth, the stable, comforting base of rice and dal, which are your debt investments like FDs and bonds, a protective spoonful of ghee, which is gold, and of course a glass of water, which represents cash for any emergencies. So with that delicious thali in our minds, let's open up our financial pantry and take a closer look at the 4 core ingredients that every single Indian family needs to build real, lasting wealth. These are your 4 non-negotiable building blocks. First up, we have equity. This is your investment in stocks or mutual funds. Think of this as the growth engine of your entire portfolio. Its main job is to grow your money much faster than inflation so that over the long term, your buying power actually increases. Next, you have debt. These are things like your fixed deposits, the public provident fund, or government bonds. These are the shock absorbers. When the stock market gets wild and bumpy, these assets are your source of stability and predictable returns. They're the solid foundation. Third, we have gold. I want you to think of gold as your crisis insurance. In times of massive economic fear, when people are panicking, gold is seen as the ultimate safe haven, protecting your wealth when other things are falling. And finally, you have cash. This isn't really an investment to make you rich, it's your emergency oxygen. It's the money you have ready to use at a moment's notice for any unexpected event without having to sell your long-term investments in a panic. Okay, this next part is maybe the most important concept in this entire discussion. The real genius of asset allocation isn't just about owning different things. It's the fact that these different ingredients behave differently at different times. They don't all go up together, and more importantly, they don't all go down together. In finance, we call this non-correlation, but I just call it the magic of moving differently. Let me paint you a picture. Let's say a crisis hits, and the Nifty crashes by 30%. Now, if all of your life savings are in stocks, your portfolio takes a massive hit. The value plummets, it's a disaster. You're panicking, you can't sleep. But now, let's look at the person who has a diversified portfolio, the one with equity and gold. In this exact same crisis, something amazing happens. As fear grips the stock market, scared investors pull their money out and they run for safety. And historically, where do they run? They run to gold. This sudden, huge demand for gold makes its price shoot up. So get this, while the equity part of your portfolio is down 30%, the gold part might be up 15 or 20%. The gain in your gold acts like a cushion, softening the blow from the stock market crash. One part zigs while the other one zags. That's the protector in action, and that, my friend, is how you sleep peacefully at night.
And look, this isn't just a nice theory. We have seen this play out in the real world time and time again. Just think back to the global financial crisis in 2008. Stock markets all over the world were in free fall, but gold prices soared, acting as a critical safety net for people who were properly diversified. And we saw the exact same thing happen even more recently. Remember the panic at the start of the COVID-19 pandemic in 2020? As stock markets were crashing, gold once again shot up to historic highs, proving its incredible value as the ultimate crisis asset.
So the big question you're probably asking right now is, okay, Krish, I get it, but how much of each ingredient do I need? What's my perfect recipe? And that's exactly the right question to ask, because your financial thali has to be customized for you. The recipe for a 25-year-old who is just starting out is going to be completely different from the recipe for a 65-year-old who's already retired. It really comes down to your age and your personal comfort with risk.
Now, a very simple way to just start thinking about this is a guideline called the 100 minus age rule. Look, it's not a perfect, magical formula that works for absolutely everyone, but it is a brilliant starting point to get a rough idea. It's simple. You just take the number 100, subtract your current age, and the number you get is a rough percentage you can consider putting into your growth assets, like equity. The rest would go into safer, more stable debt investments.
So for example, let's take someone who is 25 years old. Using our rule, 100 minus 25 is 75. So their financial tally, their portfolio, could be heavily tilted towards growth. Maybe something like 75% in equity and just 25% in debt. Now, why so aggressive? Well, because a 25-year-old's greatest asset is time. They have decades of their career ahead of them, which means they have plenty of time to ride out any market ups and downs and let that growth engine really work its magic over the long run.
Now, let's completely flip that around. Let's look at a 65-year-old who is living in retirement. Using the same rule, 100 minus 65 is 35. Their portfolio recipe should look like the complete opposite of the 25-year-olds. Maybe only 35% in equity, with the vast majority 65% in stable, reliable debt instruments. You see, at this stage of life, the goal is not aggressive growth anymore. The primary goal is to protect the capital they've already built and generate a steady income to live on. They simply can't afford to take a big hit from a market crash because they don't have the time or the salary to recover from it. The recipe must change as your life changes.
But here's a secret that, honestly, even a lot of experienced investors tend to forget. Creating your perfect recipe is only the first half of the job. The other half, the part that requires discipline, is maintaining that recipe over time. And this crucial, almost automatic process is called rebalancing.
So how does this actually work? Let's walk through it. Step 1. You make a plan. Let's say you decide your perfect mix is 60% equity and 40% debt. Great. But then step 2, the market has a fantastic year. Your stocks do so well that they grow much faster than your debt. And now, when you look at your portfolio, it's naturally drifted to become 80% equity. You see the problem? You are now taking way more risk than you planned to. So step 3 is the discipline. Once a year, you look at your portfolio and you sell some of your winning equity, which forces you to sell high, and you take that money and you buy more of your lagging debt, which forces you to buy low. And then step 4, you're right back on track. Your portfolio is restored to its original 60-40 mix. You've locked in some of your gains, and you've brought your risk level back to where you're comfortable. It's genius!
Wow, okay, we've covered a lot of ground today. I know some of these terms can sound a bit intimidating, so before we wrap up, let's do a really quick jargon buster to make sure everything is crystal clear.
First, an asset class. It's just a fancy name for a category of investments, like team equity or team gold. Simple. Correlation just measures how two things move together. Good investing is about owning things that don't move together. Risk tolerance? That's just your gut. It's your emotional ability to watch the market go up and down without panicking and selling at the worst time. And finally, portfolio rebalancing is just the simple act of tuning up your investments to get them back to your original recipe. See? Not so complicated.
And that really brings us to the most important thought of all. Asset allocation isn't about complicated spreadsheets or chasing the hottest stock. It's a philosophy. It's about creating balance in your financial life so you can have peace of mind in your real life. So I'll leave you with this one question to think about tonight. When you look at your own investments, is your financial thali truly balanced? Is it designed to let you and your family sleep peacefully at night?
If you feel like now is the time to start building that financial fortress for your family, I've shared a resource in the description below that can help you get started. Thank you so much for your time today. I wish you a life of wealth, and more importantly, a life of peace.